they were yield in that same sense. Proof of stake is really collecting inflation. Like if your asset is staked, you're keeping up with the inflation of the coin. So that's dependent on the coin's value remaining equal or higher to when you get it. Whereas yield was kind of a different beast. You could collect it in a different asset. You could collect it in stable coins, etc. And I found that lots of people were just very confused by this, and I wanted to definitely put something out here during this chat about it. That they're not quite the same. They have a similar kind of end result, but definitely proof of stake is safer. We haven't seen that fail in that same sense, but they are different. You're collecting it in that token, so that is really inflation at its core. It's not really a yield, in my opinion, and I welcome any kind of thought back on this.
So U.S. Treasuries are not yield.
I'm talking about proof of stake.
No, I know, but they're analogous, right?
I think that's fair, and I think you could say that U.S. Treasuries in ways are also keeping up with inflation. But I mean, I think that the point here does make sense, right? You can depend on that U.S. Treasury yield not fluctuating in price in the same way. And for me, I think that's the difference. Is you're also that isn't really yield unless the asset retains its value.
And we just a quick shout out to two new speakers that just joined the stage. We've got the Wolf of All Streets and we've got Richard Hart both joining. Guys, how are you?
Doing good.
How are you feeling, Richard, after the latest after Gemini's lending platform today?
Well,
another I told you so.
Just yesterday, Simon said, "You don't see the Winklevis acting like that," and I said, "Oh yeah, how about those Winklevis? I know people that can't get their money off Gemini." Oh,
I didn't say
Hart,
that, Richard.
right again.
I didn't say that. Go back to the recording. But hey, Richard, credit to you. I have been trolled like absolute crazy. You have a serious community. But I didn't say anything about Winklevi. That must have been someone else.
My bad. I thought that was you. Sorry, man. Yeah, somebody was like, "Yo, the Winklevi don't act like that." I'm like, really? They play in a rock band, dude. Like, and by the way, if you're an exchange and you don't add Monero to your exchange, you're a scumbag. Privacy is a human right. You can't operate a capitalist business without privacy. That when you go to spend your crypto, someone gets to see your entire bank balance history forever and eternity, unless you use a mixer or something that's anonymous. So any exchange out there that doesn't have Monero or some other anonymous thing plugged into their exchange, you're what's wrong with the world.
I'll give the mic to Wolf of Wall Street. Man, I've been watching your videos before the whole saga started, so I didn't have time to start watching YouTube anymore. I've been here. But what's your thoughts on everything happening? How deep do you think it will go, and how much uglier can the domino effect get?
I think there's no end to how ugly the domino effect can get, unfortunately. I mean, obviously, everyone's mentioned Genesis here, which is powering the Gemini yield product, and Gemini obviously viewed as one of the most reputable regulated exchanges. And at this point, I think it'd be better to rip the Band-Aid off and just see, obviously, where this contagion ends. The faster it happens, the better, so that we can start to, I guess, recalibrate and rebuild. I wanted to go back to what someone was just saying, actually, about the yield, and make it very clear when talking about yield, these centralized finance platforms, and listen, probably half the people here, like myself, are creditors of Voyager or Celsius. They were shadow hedge funds that were masquerading as consumer banks, right? That has nothing to do with the yield that's in proof of stake or the yield of Ethereum if you're staking in the contract. These were literally guys that were basically a prop trading fund who were doing shady things to earn yield and then pass a percentage off to their customers. And I don't think that was necessarily with malintent from the beginning. I mean, I've talked about this quite a few times. I think there was a point where there was free money in the GBTC trade for institutions like BlockFi, and they were able to pass on these massive yields. But the repercussion of that is that they accumulated quite a huge client base and customer base, and those customers were going to leave if they weren't able to give that sustainable yield in the future. So when GBTC went from obviously a premium to a discount, and then the cash and carry trade tried to go away, and then Anchor Protocol died, all of these ways that they were quote unquote safely or predictably getting yield died. Because in any market, when there's an inefficiency that somebody can take advantage of, eventually it's arbitraged away, right? It doesn't exist forever. But their problem then is that they have millions of customers, and they know that if they drop their yields to 1%, they're going to lose all their customers. So they went further down the risk curve to try to find that yield until everything exploded. So, I think that it was largely a poor business model that got them trapped, and then everything exploded down the road, but definitely not the same as the yields that are offered in proof of stake. But as for what comes next, it's hard to predict.
Fun fact, man. I've got a yield generating product that's been in business for 3 years. It's perfect flawless operation. And the price went up 10,000x. And it's only down 95%, while everything else is down 75 and 85.
So really
I've
quick,
been quiet
Grant,
about it, but
some
like
breaking
nobody talks
news
about
here
it.
from the Bahamas. The Bahamas office of the Prime Minister says the Bahamas did not have sole oversight of FTX's worldwide operation, have given directions that proceedings and investigations are to be of the highest order. Office of Bahamas Prime Minister says, based on understanding of the FTX crisis to date, we have not identified any deficiencies in our regulatory framework that could have avoided this.
Everybody's going to punt the ball to someone else, right? I mean, you can see
This
how
is
fast people are running away from any responsibility for anything. I don't think that that's unexpected.
Well, let's just
I
be
think
honest.
this is going to be another thing.
Guys,
Oh, sorry, Ken.
Let's just be honest. I think we are all on the same page when we say that Russia did this.
I think this is going to be another thing, which is transparency of organizational charts and what entities does what. So one of the things we had to do in our terms and conditions was actually publish which entity the shares are with, which entity operates the platform. And so I think this is going to be another thing. You would expect that as traditional due diligence if you were investing into a company, but now I think we're getting at the level of ultra transparency where organizational charts and what the entities do is going to be in the terms and conditions. And I suggest this would be one for people would be very curious about with Binance as well.
Here's a question for you. Why doesn't this take 10 years like Gox did?
So that was in the Japanese court, and then it went into bankruptcy, and then it came out of bankruptcy because the dollar value of Bitcoin put it into a new process called civil rehabilitation, which was then subject to all of the legal disputes where every time you were about to pay out clients, some dickhead that said, I created Mt. Gox US and you owe me $15 billion could hold up the whole process.
Yeah, so I guess if you don't resolve it before Bitcoin's next pump in 3 or 4 years, then you get that same problem.
Yeah, they're in Chapter 11. And I'd expect it to go to, if there's criminality, it would go to Chapter 7. And there's not many assets to liquidate like Mt. Gox because all of the Bitcoin's been hacked probably. So I'd expect it to probably be a 2-year process rather than the whole Mt. Gox thing.
And a 2-year process where you're effectively saying that people get nothing in the end.
Well, it all depends upon what Alameda did with the assets. So they may have invested in a bunch of private equity, and they may have just been, Solana-based companies and NFTs and things like that. So if that's all marked to zero, then the value's gone. I talked about it earlier, but I'll repeat it here. The key issue that I think is going to come up in this one is that essentially client funds were used by Alameda. And Alameda really, the creditors in Alameda are probably going to be hedge funds and sophisticated financial institutions. And the creditors in FTX are going to be retail plus all the sophisticated financial institutions. So it depends whether those hedge funds have more exposure on the Alameda side versus the FTX.com side. So what I think is going to happen is bankruptcy proceeding is more likely to favor unsecured creditors if and only if you can demonstrate that actually the hedge funds were using the proceeds of crime because client money was not meant to be used. Now, here's the key difference with Celsius. They just simply didn't have, they illegally operated a hedge fund and a fractional reserve bank. And because they illegally did that, the ambiguity of Celsius claiming, so Kirkland and Ellis, the legal team, claimed that all deposits were actually the property of Celsius. And they changed the terms and conditions to reflect the fact that the previous CEO was essentially playing hedge fund manager and VC with client money. With the difference here is that because it was actually a regulated institution in Bahamas, that means that regulations define client money legally, and therefore client money was actually used. And therefore, if client money was used, you could argue that the hedge funds in Almeida were the beneficiaries when they took out their loans or collateral of the proceeds of crime, which then would be the unsecured creditors and FTX.com, which would be more retail. So I think this is going to be hedge funds versus retail. And I think we need to ensure that the depositors and creditors at the FTX.com side are the ones that win the argument. And I think, not a lawyer, but I think the proceeds of crime would be the defense there.
Richard, I think
I'm
you're
more
right.
concerned.
That's going to take a while.
I'm more concerned with so if you resolve all of these bankruptcies and you distribute what's left amongst the creditors, they're not guaranteed to sell. It's not 100% sell. But we've got some other big coin amounts out there that I'm pretty sure are 100% sell. So when the Department of Justice seized $1 billion